Today's episode of Hidden Forces is made possible by listeners like you. For more information about this week's episode or for easy access to related programming, visit our website at hiddenforces.io and subscribe to our free email list. If you listen to the show on your Apple Podcast app, remember, you can give us a review. Each review helps more people find the show and join our amazing community. And with that, please enjoy this week's episode. What's up, everybody? I'm Demetri Kofinas, and you're listening to Hidden Forces, where each week I speak with experts in the fields of technology, science, finance, and culture to help you gain the tools to better navigate an increasingly complex world so that you're less surprised by tomorrow and better able to predict what happens next. My guest this week is David Kotok, co-founder and CIO of Cumberland Advisors. Mr. Kotok's articles and financial market commentaries have appeared in the New York Times, the Wall Street Journal, Barron's, and other publications. This is a fascinating conversation that spans a wide range of issues currently facing the global economy, as well as subjects and themes stretching as far back as 5th century Athens. I asked David for his opinion on a series of topics, including trade, the U.S. dollar, European monetary policy, as well as what markets he thinks are most at risk as the Fed continues down its path of tightening and as protectionist trade measures begin to introduce new anomalies into the American economy. David also shares his experience investing during the turbulent years of the 1970s and how the lessons he learned during that decade can be applied today. We also discuss David's outlook for credit markets, specifically the riskier areas of the corporate bond market, including leveraged loans and middle market lending. How can investors adjust their strategies to protect themselves against some of the nonlinear impacts of government policies while still positioning themselves and their clients to profit from the rising tide of economic growth? With that question and others in mind, let's get right into this week's conversation. So, for those in our audience who aren't familiar with you, you've been around for a very long time. I've been familiar with you and your work and your writings and public musings for years. I mentioned to you that you had been on Capital Account in 2012, and we were discussing Europe and the ESM, I think, and some other timely matters of interest rate policy. And here we are, 7 years almost later. Tell our audience a bit about your background, how long you've been working in finance, and a bit about the Cumberland Advisors.
You know, it's interesting when somebody says you've been around for a long time. So that's a long time. I don't know how much time we have for me to go through this whole biography.
Well, I was telling you that this happened also with Bill Janaway and with Howard Marks. Both of them began their careers on Wall Street in the very early 1970s. Same with you. And I was telling you also that I feel that that period is heavily understudied, and it isn't something that people discuss. You hear people talk about 1987, 2008, but the 1970s aren't discussed, and I wonder to what extent they may be a relevant point of history to look back on as we try and project forward.
If you think about, I was an undergraduate at the Wharton School in the early 60s, so I was in the class of 65. And in those days, we had a war going on, in the Vietnam War, which built up. And so I was in the Army from 1966 to 69. And the transition from the early 60s was underway, and it was a rapid transition. And depending on where you were, you saw it differently. For me, I saw it in a uniform. You know, there's 500,000 men in Southeast Asia. I was in the Army, not in Southeast Asia. I happened to be in Germany on a special assignment doing something for the Army. But the fact is there was this dramatic change, and the dramatic change happened in a number of ways. You saw the demise of the fixed currency regime under Bretton Woods, the buildup and changes that took place. And then you experienced the troubles of the Nixon regime. We talked about it before we started to record this for a second. So you think about a president who comes in, inherits, and ratchets up a military circumstance, is a beleaguered president and winds up resigning over what was otherwise a threat for impeachment.
Mm-hmm.
Before that, the country, as I remember it, had a different theme. There was an acceptance of things. I remember the 50s. Patriotism was intense. At the end of the 60s, the country didn't understand the war in Southeast Asia, didn't want to be there. So you had division in the country as opposed to unity. There's a message in that, I think, for the current times, because we're in a very divided America. And both sides of this division are polarized. So you have a sort of an intensification from the right and an intensification from the left and a bewildered middle that can't find a place to go.
Mm-hmm.
Similar structure took place in the Vietnam era and the post-Vietnam era. So there's a similarities. Now, can we learn lessons from then so we don't repeat mistakes? That's the profound question we have to address.
Well, you mentioned it was obviously a period of change. Would you say that it was also a confusing time?
What is a confusing time? So a confusing time is when you think, a person thinks, they're prepared, they have a scale of history, they have some sense of trend, trajectory, and all of a sudden things aren't working. That's a confusing time. I would submit that that's normal. And it's the periods of calm when you feel comfortable, stasis, predictability, that is the unusual one. The human being on this planet has lots of periods of time which are in turmoil, and few which are calm and peaceful. It's a shame, but that's the nature of our species.
Do you feel that, of course, speaks to the last 10 years, particularly the last 6 years? Do you think that, and if you want to talk about human beings, species, I think you mentioned, I think often about financial markets, well, I think about them in various ways. One of the ways in which I think about them is as an ecology. And do you think that this tranquility has bred a certain level of placidity, and that investors have lost some of the acumen for the type of skillful investing that would be required at a transition of market regime?
Well, think about, we had a run-up to a financial crisis. Then we had a crisis, and we had an economic downturn at the same time we had a financial shock. We haven't had one of those since the 30s. So there was no recent institutionalized memory to guide anybody. The response to the financial crisis this time was to take the interest rate to zero and create huge monetary liquidity. That's what we did in the United States with Bernanke as chairman of the Fed. That's what the European Central Bank did. It's still doing it. That's what Japan has been doing for over 2 decades. You think about the fact that the central bank in Japan holds more assets than the GDP, the gross domestic product, of the country.
Almost 3 decades.
Yeah. So we have this period. So what happens when you have such a period? You create, first, an expectation that it won't last long. Because people believe it won't last long, they don't change their behavior and they exacerbate the downturn. That was the beginning.
What, 2009, 2013,
yeah, I would say
2011?
I would even say 2008 and 2009 to start with. Mm-hmm. After a while, that starts to change. Interest rates in the United States were zero for almost an entire decade. And they are only now beginning to restore some normalcy. Think about it. The person had a bank account. The interest earned in the bank account was near zero. The CDs that they had previously purchased, which paid 4 or 5%, matured. They had counted on 4 or 5% forever. What did they get? Zero. And they didn't like it, and they had to change their behavior and their plans. If you look at the financial professionals today, any one of them that's 40 or under doesn't know from experience anything other than zero. Now, they may know it from a book.
They've never seen an interest rate.
Well, they've never seen an interest rate. They may know it from a book. I have a book or two. People can read it. But it's different than when you experience it. And suddenly they're confronting something that's strange. So what's confusing? Was the zero interest rate period the reason, the source, the confusion? Is the restoration of something else, which is what we're going through now, the source? Is that confusing? I don't know what's confusing. Everything's confusing.
Indeed. Well, the negative interest rates is confusing. Another confusing, something you said there, I think it was the Japanese monetary easing and the growth of their balance sheet. Similarly, in the United States, we've gorged. The Fed has ballooned its balance sheet. When you were on capital account in September of 2012, the Fed's balance sheet was approximately $2.9 trillion. We had added $2 trillion, and that was a big deal. Now we're at, what is it? We're almost, we went
$4 trillion.
$4 trillion.
Yeah, they're trying to shrink it, and the rate of shrinkage is now on a schedule of $50 billion a month. So you really think about what happened. We had a financial crisis, okay. The balance sheet for the first time in generations was taken above the requirements for the natural liabilities of the Fed. What were the natural liabilities? All the currency in circulation, pictures of George and Abe and everything else, that's a liability of the Federal Reserve. The required reserves in the banking system, that's a liability of the Federal Reserve. And then there's a small balance, which I would call what's needed for transactions to facilitate the U.S. Treasury's operations. That's what the Fed was all about. All of a sudden, they have to create another $1 trillion worth of excess reserves. Changes everything. They set an interest rate on it. Changes everything. The mechanics of it were to address the financial crisis. That was the beginning. Then they had a problem, say, 3-4 years into the crisis or after the crisis. When they stopped, the market started to get scared. So the Fed had to then take the level up another time, actually twice. And they did so in order to convince market agents, investors, business people that they were not going to let a national or international failure, disaster, catastrophe happen.
That was QE3.
That was QE3. QE1 had a very specific purpose, and by the way, I happen to think they did the right thing. The world was ice, frozen. They had a thaw it. QE2 and QE3 were different types of monetary policy. They were not triggered by that. They were triggered by a fear to address and an encouragement which they wanted to give as opposed to thawing the ice. Now, that you look at them, expansion of the balance sheet of the Fed, they look alike, but they were quite different. Motivation was different. Now what's the Fed doing today? It's trying to raise an interest rate and shrink the balance sheet at the same time. Mm-hmm. No central bank in the history of modern central banking, including the 100 years of our Federal Reserve, has ever done that before. That's a grand experiment. And if you look at the composition of it and you say, this is the same Fed that tried to equate the increase in the balance sheet to changes in interest rates, and now it's shrinking the balance sheet. Can we equate that in reverse? And the answer is maybe. We can estimate it.
When you say equate that in reverse, you're
Does a shrinkage of the central bank's balance sheet equate to a rise in interest rates, just like an expansion of the central bank's balance sheet equates to a fall in interest rates? And are they, therefore, double piling on by raising the rate and shrinking the balance sheet at the same time? I think they are, by the way, and I think you are beginning to see the effects on the stock market, in the housing market, in rising mortgage interest rates. I think the Fed is in an experiment that's dangerous because they're trying to do two things at once.
They're contracting in two different ways.
Two different ways. And maybe it'll work. Maybe they'll stop in time. But I would say in my lifetime, and as you said, I've been around a long time, I chaired a central banking series that was global. I've never seen a central bank do two things at once and do them well. They have enough trouble doing one thing and doing it well. So I think this is a difficult time. And I also think the Fed is beginning, at least some of the members of the Federal Open Market Committee, are beginning to question how well they can forecast things. And that's good. That's what they should do.
Well, let's talk about some of the, well, we know we could speculate, and certainly there's evidence for how the Fed's monetary policy the last however many years has impacted financial markets. But what about some of the anomalies it's generated and areas that are particularly at risk? For example, the corporate bond market. That's something that is, you think, at risk from this Fed tightening more than other sectors?
I think the lower credit quality, the junk bond side of the bond market, is at risk. To me, investors at zero interest rates, year after year after year, chased yield. They went to places to get more yield, more interest payments, and they did things which were behaviors that took on risk. And year after year, we saw that build up. So we have this situation today in which we have a huge inventory of lower grade credit in the bond market. Not the highest grade credit, still pay. Lower grade. And now we have the Fed tightening things, and we have the economy experiencing a shock from a trade war at the same time. I hope we get to talk about the trade war because it's a big deal. And therefore, risk is rising. When risk rises, where does it evidence itself? Usually in the lower credits, usually in the junk bond sector or the low investment grade sector, and we're beginning to see it. We see it with the General Electric, which is now the lowest investment grade by all three rating services. Who'd have thunk it? Think back to GE when it was a monster company. Would you ever have imagined that it would be rated triple B or BAA? So circumstances change, and they're dramatic when they do.
Well, the leveraged loan market has moved above, surpassed $1 trillion, right? It's doubled since 2012.
Big. Yeah, it's big.
And there's been a huge growth in middle market lending as well.
Yeah, also big. You encourage things when you take the interest rate to zero.
Right.
And you keep it there day after day, month after month, year after year. And then when you try to undo it,
right.
And that's what we're going on. And you begin to think about the world. The Japanese are not doing anything to undo anything. They can't. They're stuck. And the Europeans talk about undoing things. And whenever they even mention it, in the future, meaning a year or 2 or 3 away. They rattle the market.
Are the Europeans in an even tougher spot, not just because of the political dynamics, but also because of the demographic issues in Europe that are different than the United States?
Tougher is a relative question.
Relatively tougher.
Let's say they're in a tough spot and that politics are not like ours. You think about the Eurozone. It's a different construction. You think about the European Central Bank. It's a different construction than the Federal Reserve. And they have to take their policy interest rate up to 0 from a minus number. Can you imagine what you have to do?
And they haven't officially ended their bond buying program yet.
No.
They're supposed to end it, but we'll see if that happens.
Well, they talk about scaling it back, which is baby steps. Because why do you take baby steps? Why do you do things very gradually? Because you're afraid.
You're a baby. You don't have muscles in your legs.
Yeah, well, that's right. That's right.
And they have something that we don't have, which is they've got Italy. They have the Italian bond market.
Italy, yes. You know, you talk about history. I remember when the differential between the German interest rate in Deutschmark and the Italian interest rate in lira, now I'm an old guy, so I remember those things, was 500 basis points, 5 full percentage points. And in Italy, it was so distrusted in the bond market that the Italian government was issuing more and more short-term debt because no one would buy long-term bonds.
Especially the Italians.
Yeah, well, they knew better. So you had something which we call rollover risk because you had to roll your debt all the time. And that's the conditions in Italy. And the conditions in Italy are profoundly different than Germany. And so you have this situation in the Eurozone. We measure this with something called a target to balance. That's a mouthful. It's technical. But what it does is measure the differences among and between the countries to figure out within this one currency zone which country is subsidizing the other.
Trying to figure out what the interest rate differential actually would be if these were
Well, we guess. This is a guess because you only have the euro. There's only one currency. Right. So in the United States, we have 12 different Federal Reserve regions. Nobody in the United States even thinks about the fact when they make a payment in San Francisco and they deposit it in Atlanta, they've really made a transfer from the Federal Reserve Bank of San Francisco to the Federal Reserve Bank of Atlanta. People take it for granted. We don't even think about it. We transact gazillions a day and take it all for granted, and it works. But in Europe, that wouldn't happen. If somebody makes a payment from Rome to Frankfurt, they are going through 2 national central bank systems, and the combination of them all fall within the European Central Bank. So what happens? The Italians lose cash, the Germans gain it, and therefore the Germans gain a claim on the Italians. As long as the Germans are willing to extend that credit, which they are, and that credit is now €1 trillion. That's a big number.
Yeah, and just to further your point, that was at the root of what happened in Greece, for example, with its banking crisis. Money, of course, domestic capital invested in Greek banks, and the Greek banking system flooded out of the country.
They wanted to get their money out. Right. Who wouldn't if your system was coming
Prisoner's
apart?
Dilemma 101.
That's right. Prisoner's Dilemma 101.
So you mentioned trade. I do want to get to that. Let's maybe skip ahead and discuss trade a bit now, because I'm curious. And when I say trade, I'm not thinking just about the United States and China, but I think because there's protectionism of trade happening with the Europeans, with the Canadians, but it's really the Chinese that incorporates geopolitical anxieties and where the rhetoric is also very populist and strong in a way that it isn't with the Europeans or with the Canadians. You've devoted, I think, an unusually large amount of time talking about this relative to other fund managers that I've seen. And like I said to you, we've covered China on the show on 3 separate episodes, but we never really talked much about the trade war. So this is an opportunity for you to educate me and the audience on why you think this is so important and why this maybe isn't just rhetoric and hot air.
Well, we haven't had trade war protectionism experience like this in a couple of generations. So it's new. We didn't have preparation for it until the beginning of the year. You think about the first couple of years of the Trump administration. We dealt with tax cuts. We dealt with repatriation. We dealt with issues like deregulation. There was little discussion of tariffs, trade barriers, protectionism, retaliation. That came later. So this is a new phenomenon. Secondly, the president invoked a statute which dates back to the 60s. And the Congress gave the executive branch a power during the Cold War in the 60s, where the executive branch could impose protectionist methods, tariffs, for example, if they were to declare that it was an item of national security. Trump has used the national security statute of half a century ago to invoke a tariff. Now, I would submit to you if you said to me, wait a minute, isn't an intellectual property theft by a Chinese company from an American firm an issue of national security? Well, it could be. What the hell does that have to do with soybeans? Are soybeans national security items? Is a lobster tariff in New England a national security item? I don't think so. So the intensity of the trade war rhetoric went from the specific to the general. And it was driven by the politics, which I would say are the politics of the nationals, Bannon, Navarro, as opposed to the internationalists. And we have that division. The results were predictable. The people who were sponsoring the national agenda didn't want to hear the argument. Peter Navarro is a hardline, harsh, anti-free trade personality. He wasn't that way many years ago, but he is now.
Does he have an official role in the White House, or is he just an advisor to the president?
Well, he's an advisor to the president on trade. Lighthouser is the official trade negotiator. And the White House bought the line. It was maybe you had Steve Bannon as a cheerleader for it. So you structured a very intense attack on trade. The way it works within the WTO rules, the World Trade Organization rules, which, by the way, it was the United States which advanced it. It was the United States that signed trade agreements and treaties. And it was the United States that invited China into the WTO and sponsored him. They didn't originate this. We did all that. We were the original actor trying to broaden global trade, and we were very successful at it for 25, 30 years. The amount of protectionism in the world declined. And look how much better the world became. That's reversed.
So I think, just as a point of history, I think they were admitted in 99 and they got it in 2001, something like that.
Yeah, but there was a timetable.
Right, exactly. But to this larger point you're making about how the United States has effectively subsidized globalization.
For good,
similarly,
but for a reason. For a reason, it reduces war.
Sure. So, well, I mean, a few things. The larger point I was trying to make was that the Brits played a similar role in the 19th century and early 20th century, correct? And the United States was able to free ride off of that. They were able to benefit off of the international order that the British were able to create. Something similar has happened with the Chinese, right? And we're at a point now where the populists have taken basically are trying to reverse the last 30 or 40 years of liberalization, which includes, of course, our relationship with China, while attaching to it all of this advanced war rhetoric. Can we continue to proceed forward as we have been proceeding with the Chinese government, given some of the other things you mentioned, intellectual property theft, right? Is it possible that maybe this administration, by using such inflammatory rhetoric, I actually have a quote here due from Steve Bannon, I'll quote this, because I think he has been one of the most effective communicators of the Trump policy. We're a tributary state to China, right? We're the Jamestown to their Great Britain. We're finally engaged in the economic war that they've had against us for the last 25 years. So could it be possible that the Trump administration effectively comes out? We've asked this before, of course, of the Trump administration, and no one really knows. But is this something that is just a negotiation ploy and they're coming out hard, but in the end they're going to extract concessions from the Chinese and some badly needed concessions, issues with, again, IP and technology and maybe having fair relationships for our tech companies in China? Or is this going to, you think, kind of fly off the rails and it's going to lead to exacerbated real geopolitical tensions?
Well, one might argue it's already off the rails. What is your purpose? So let's talk about it for a second. If you impose a tariff on a good or service coming into your country, what are you really doing? You're raising the cost of that good or service for your domestic consumers. Essentially, the Trump-Navarro government trade policy is a sales tax levied on the citizens and consumers in the United States.
Well, you mentioned the lobster
Sure.
companies up in Maine. Can you give that anecdote? What are the details of that particular example?
Well, I happen to be familiar with that one because I organize a group up in Maine
I wanted to
every
ask you
year.
what the consensus was this year. Is that in
Yeah.
August that you guys get
Yeah,
together?
in August we get together, and the consensus among this group, there was, we're 50 people, men and women, who are in financial services and economics and other disciplines, and probably represent collectively $1 trillion in assets in different institutions.
Yeah, it's a pretty heavy-hitting crowd.
Well,
Truth be told.
it's an environment in which heavy-hitting, I don't want to address that, but it's an environment in which people can speak relatively freely and have an exchange of views. So we happen to be in Maine in the middle of the tariff war. What happened? The United States levies a tariff on China. China retaliates. What does China do? It levies a tariff, a counter tariff, on the fisheries exports of the United States, which are huge. It's a big business for American fishermen, lobstermen, you name it, to develop and export the product of fisheries. Lobster's one of them. So, the cost of lobster in China coming from America goes up. Chinese raise a tariff that's a counter tariff. Had we not had a first one, they wouldn't have retaliated. So they retaliated. What else was the tariff on? It was on the lobsters that the Chinese like to eat, which are the harder shell lobsters. The lobstermen in New England, Maine, Massachusetts have two markets. The softer shell lobsters, which Americans like, and the harder shell lobster, which they export, and that's how they have a year-round lobster business. At the same time, China cut the tariff on Canadian lobsters, and we were engaged in a trade fight with Canada. Think about this. Pick a fight with your most dependable neighbor, that you have a 4,000-mile peaceful border and enduring ally in Canada. Go visit Normandy and walk the beaches. You know the American beaches. How many people then walk down a little bit and walk the Canadian beach? We forget about these things. So we pick this fight with Canada, and in the midst of it, we pick a fight with China and ratchet up. What do the Chinese do? They lower the tariff on a lobster from Canada, and they raise one on the U.S. The U.S. lobsterman is hurt. 4,500 family-owned lobstering businesses employ, 5, 6, 8, 10 people, have a few million in a capital investment, have bank loans and financing for the lobster boat and the equipment. We took a swing at the Chinese and we punched ourselves in the face. That's what the lobster thing, that's a little snippet. Multiply that by billions.
Well, how many billions? I've heard a number like 150 billion. Is that right, or am I pulling that out of...
The thing is, if you levy a tariff on so many billions of items, remember this whole thing started with a washing machine and steel and aluminum. If you levy a tariff, do you expect businesses to continue with the same items in the same quantities? No, they will make quick adaptation for their own survival. And that is happening. What it's doing is causing the following outcomes economically. We raise prices because we impose a sales tax. We lower efficiency and productivity because we alter the selection process of the lowest cost or the best quality. And the third thing that's the worst, which takes time to see, but it's now showing up, is we discourage capital investment, future investment, because we create an unknown, an uncertainty, no reliability. How do we know what they're going to do next? So what do? You say, wait a minute, I'm not going to go buy that widget machine because I don't know what things are going to be like. I'll wait.
Right.
And when you do that, you slow down the economic activity.
Right.
I'll give you a personal example. I was a speaker out at the Rocky Mountain Summit in Wyoming, near Jackson Hole. And on the break, after a panel, I went over in the lunch, a lovely spot, lunch outside, and there's two men sitting at a table. I went up to them and I said, do you mind if I join you? And they said no. One was the mayor of his town in Idaho. And another one was a city councilman from the same town. The mayor was a lawyer, and the city councilman was in the financial services. And the two of them had come to the Rocky Mountain Summit because of the discussions which included trade. So I said to them, tell me something. In your town, have you seen any direct effect of the trade war? The immediate answer was yes. I said, can you tell me what it was? He said, yes. We had two companies that did international business that selected our town in Idaho. They acquired land. They applied and were permitted to build two facilities. And they put it on a dead stop because of the trade war. I said, so how many people would have been employed in your town? They said about 200. How much investment would have been in your town? One was 30 million and the other was, 6 or 8 million or something like that. I said, how many people live in your town? They said 16,000. I said, for a 16,000 population town, that's a big deal. They said, it sure is. So I said, do your citizens, your constituents, understand that this is Peter Navarro, Donald Trump, Lighthizer, trade war policy that kept your town from having ratables, funding your schools, having a new ambulance, creating a couple of jobs? And they said, well, they really don't associate it because they don't see it. I said, so if you had a plant in your town and it closed and 200 people went out of work,
right,
they would get it.
Good point.
But if they don't see what happens...
Opportunity cost.
You got it.
You can't measure the opportunity cost.
You can't measure the opportunity cost. But here's how you see the opportunity cost. The growth rate in the second quarter of this year in the United States was 4%. My view is it peaked. The growth rate is going down. And inflation pressures are rising, albeit slowly, but they're intensifying. Why? Trade war, protectionism, tariffs, barriers, uncertainty premiums, add them all up. And that's what Peter Navarro, an economist who used to think straight, in my opinion, and is now confused and very rigidly defending himself now, advised, and the president bought it. Now, I would add, I think Trump has other people delicately but clearly saying, wait a minute, we're hurting ourselves. So my hope is...
Does Kudlow play that role in the
I think so.
administration?
I know Larry Kudlow for 35
This
years.
goes against the... Okay, so I remember, this is funny because I remember watching Larry when he had just split with Kramer, and he went from having Kudlow and Kramer to having Kudlow and Company. This must have been like 2006. And I remember him saying, I love trade deficits. You want to know why? I'm paraphrasing, but I think this is pretty accurate. He goes, I love trade deficits. You want to know why? Because they create capital account surpluses.
He's right. Whether you love him or don't love him.
I mean, yeah.
Okay?
That's a Larry Kudlow type of a quote.
If you're going to run the federal deficit up, you need a capital account surplus to finance it.
But doesn't it also matter where the surplus goes, right? It's one thing if the Chinese were doing a lot of foreign direct investment in the United States, but a lot of that money has been used to subsidize the United States bond market and depress their currency for years, right?
No question about it. If all the borrowing of the United States were invested in productivity improvements, we would have a flourishing, exciting place. Look what we're doing, though. We have labor force shortages. We have more job openings in the United States today than we have people calculated in the unemployed to fill them. I cannot ever remember that circumstance in my career, which is almost half a century.
And what accounts for that in your view?
Well, we have unfilled job openings. Now, there are reasons. Do we have unfilled job openings? Because training is not adequate. Is there an education issue? Do we have people in the wrong geography? The job is over there and I'm over here. There's a lot of those kinds of questions. The end result is we have that. So we have difficulty in filling jobs. We're in a place in which our employment facilities call for more labor, and we're putting in barriers for the labor to get here. And at the same time, we have created an uncertainty premium on capital investment to make the existing labor force more productive. This is a bad proposition for the country.
I want to follow up on something, but I want to mention something before I do that. The thing I want to follow up on is combining the conversation we began with, which is the interest rate tightening and the contraction of the balance sheet of the Federal Reserve, and this uncertainty around trade, how those things might work together. Are there, again, some lessons around the 1970s in that case? But before we do that, I want to ask, right now we're talking about the effect of tariffs and protectionism on United States businesses operating locally. But what about our trade partners? How does that impact American companies working overseas? Does it drive some companies to go to third-party nations which are less hostile towards the Chinese? I mean, how does that impact?
I saw that myself on a trip to Asia where I visited Vietnam. And I saw a factory facility move from China to Vietnam. That was a capital decision of an entrepreneurial Asian businessman to leave one venue and locate in another. Why? Because they saw negative impacts taking place in China. China doesn't want to have a trade war with us. And most Americans, I find, as I travel around the United States, don't want to have a trade war with China or Canada or Mexico or the Europeans or anybody else. What Americans don't want is thievery of ideas. That's the intellectual property issue.
Huge problem.
Yes, but that's the case. Have a policy which is targeted specifically to it. Don't punch out the farmer who's not involved in an intellectual property issue.
Right.
That's the difference. I don't believe a broad shotgun tariff policy has any advantages. Let's use rifles and be very precise. Two things happen. The first is you don't damage the periphery. You don't have the secondary damage. You don't have a destructive sentiment which is not understood. The lobsterman doesn't know why he is being punished. He didn't do anything wrong. Secondly, you have a policy which can be understood by the general public. And when they do that, they will rally in a patriotic way, not a divisive way. And so I'm sorry to see how this evolved, but I believe it can be fixed. I believe it's curable. If it isn't, we're headed for a global slowdown, maybe global recession. Pain in financial markets. It's not a pretty picture. If there's a truce in Buenos Aires, they don't have to make a deal, new deal. Stop the shooting. Wave the white flag. That alone will alter circumstances for the better. I believe that could come in the next few days.
So let's throw a few dates out there. You mentioned Argentina. You're talking about the G20. We're recording this on the week of Thanksgiving right now. This is a Wednesday. The meeting in Argentina, I believe, is going to be next Friday. So basically the week that this episode comes out. They recently met at the Asian Pacific what's the name? Asian Pacific Economic Cooperation.
Yeah, APEC meeting. And
APEC meeting.
Pence went and he was belligerent. They couldn't get a communique.
They couldn't get a communique together. So the markets already have that baked in. It seems to me that anything that's positive would surprise to the upside, it seems like. And then also, of course, there is the baked-in, or was baked-in, rate hike. But it looks like markets are beginning to reprice the possibility that the Fed may not actually hike in December.
They may. That's speculative, but I think the Fed is committed to December. The question is, does the Fed ratchet back the expectation for 2019, which I believe is in the cards, because the evidence is not supporting 3 to 4 rate hikes in 2019.
Speaking about unprecedented things, I mean, just looking at the Fed funds rates since, I don't know, go to the 70s, maybe even 1981, you look at all the recessions. Each recession has started with lower rates. I mean, we're now at what? We're at 2%, 2.25%.
Yes.
Let's say we get to 2.5. If we were to go into a recession at that level, have we ever had a recession with interest rates so low?
Other than the financial crisis, no.
Well, I mean,
before the financial crisis, they were higher.
Bernanke began to lower them when the fracture started to emerge in 2000.
Well, if you think about the history, when Greenspan retired and raised rates and Bernanke became chairman, Greenspan took up rates quarter point at a time on a regular basis. Bernanke now inherits a higher interest rate platform, a banking system that has extended credit into the housing sector, some of it in very complex instruments which blew up.
Mm-hmm.
So you could see that evolving in 2005, 2006, 2007. I remember when we took the weight in the financial sector way down a year before the financial crisis, because we could see the evolving problems. I remember when Bear Stearns had a $2 billion loss from a hedge fund. They said, oh, it's nothing, don't worry about it.
Mm-hmm.
And 9 months later, they were gone as a firm.
Mm-hmm.
So you could see the warning signs. Think about that today. The warning signs in the capital structure, in the banking system, in the higher quality credits are not there. Our banking system is solid in terms of capital. The warning signs are in the junk credits, the speculative side.
Private placements also. There's been a huge bubble in private placements. And I know you're a big fan of cryptocurrencies, too.
No, I'm not a fan. I don't have them, and I think they're trouble.
You gave out chocolates to the Bloomberg people. You didn't bring any here for us?
I didn't think of it. I didn't know you liked it.
Nice. We love chocolate here. My engineer loves chocolate.
I'll bring them. Well, listen, it's more healthy to have dark chocolate, not milk chocolate. Those are milk chocolate.
I'm a dark chocolate fan, too. Gary Schilling was on the program about a year ago. and he brought us his honey.
Oh,
he
his
makes
honey's wonderful. Yeah,
so
I
we
know
love
Gary.
when guests bring us food. But I took you...
Next time I'm back, I'll bring you some Bitcoin chocolate.
Okay. So I took you off track, but you were talking about where the risks are in lower quality credit, private placements, cryptocurrencies, etc. But that's what you were saying and when I interrupted you.
Yeah, the higher risk, less transparent, less understood areas where investors chased them because they were hungry for yield.
They needed the yield.
Well,
some of these funds needed it.
They took risks, and they took risks they didn't fully understand, and now they're being punished for them. I don't believe a recession is in the cards. It doesn't have to happen. It's in no one's interest to happen. And I think the Fed is sensitive to that. Whether the White House is willing to get to a truce. Let's stop the fight and determine later who's going to win it with negotiations instead of this bellicose acrimony. That alone will calm markets. Positive things will come from that. I hope that happens soon.
Your point is that it's less likely that the Fed, with its tightening, will cause a recession. It could, as an eventuality, if it continued to hike, but that more likely the uncertainty and the escalating rhetoric around the trade war, and if, let's say, something further goes off the rails in Buenos Aires, that is more likely to cause actual, real, meaningful contraction in the economy, which then could, of course, have knock-on effects in credit markets, starting with the riskiest tranches.
And then the multipliers are negative, and they can intensify.
So what about the U.S. dollar? It regained about half the losses that it generated in 2017 this year.
So you look around the world, and you see major currencies. The dollar's the big guy. About 60% of world reserves are in dollar. The next one's the euro. That's about 25% of the world. All the rest of the world, tradable currencies make up 15%. So they're nice places to visit, Sweden, Switzerland. They're important. That's not where the action is. The action is in the U.S. dollar first. So whether we're the best or the least worst,
The
or
cleanest
however,
dirty shirt.
Right. We have a strong economy, 20 trillion in size. We have a banking system that is capital strong now, and we have a supervisor regulatory system. We have crazy political divisions. But in the end, we also have very strong institutions in the United States. I believe in them. I believed in them all my life. There isn't a single American that thinks, I better take my money out of the bank because I'm going to lose it, the bank is going to fail, and the government won't pay me. So you think about what I just said. The Federal Deposit Insurance Corporation, which guarantees the bank deposits of you and me and everybody in this country, is an insurance operation with a credit line to the U.S. Treasury, which is in debt $1 trillion a year now, additional debt, more or less.
With an implicit guarantee by the Fed.
And it's a political body in Washington, D.C., and the board members are appointed by a political organization, yet the country accepts completely safety and soundness of its banking system, and it does so because it's been proven under attack to be defended by government. So it's possible for government to be credible, to have safety. It's possible. There's an example.
You just made me think of something when you were talking there, which is about credibility and that they were proven under attack. Central banks, and let's just look at the Fed during the financial crisis, operated in an environment where they had inherited the confidence that markets had in the Greenspan Fed, the maestro. The markets played to his tune. So when Bernanke came in, there was some memory of that, some institutional memory of the strength of the Federal Reserve, Volcker as well, but that was in a different way. I wonder, has the credibility of central banks been damaged? To what degree, if it has? And the fact that rates are lower, the balance sheets are larger, is there some material lack of credibility that banks have? And given the central banks and given the experience of the Japanese, do you think that not in this particular sense that the notional value of someone's savings can't be insured by the FDIC, but the larger thing about government credibility and the credibility of banks to prevent an economic contraction in real GDP, that maybe there's been some assault on that credibility?
Well, I think the recent experiences call into question the degree of credibility. So the action of the U.S. central bank is now critical worldwide because it's being tested on credibility. Very capable people in the Federal Reserve, I know a number of them personally. Some of the presidents are highly skilled. These are well-meaning people. They take what they do very seriously. They are confronting circumstances that they didn't plan on. Trade war is an example. They didn't think about it 2 years ago. It didn't exist on the radar screen. They have economic forecasting models that are very complex. They're based upon structures which are not applicable as easily today because the world's a different place. So
brings us back to the 1970s.
Well, there you go. We went through that. So
broken Phillips curve.
Are we going to do it again, or are we going to learn from history? I wrote a piece, and that maybe this is a good end, on Thucydides and the lessons from Greek history 2,400 years ago. And it was interesting doing the research to write that. I found there was a period of 30 years in ancient Greece when there was the first example of the World Trade Organization. Can you imagine the city-states in Greece set aside war with each other?
Delian League.
Yes, and they said, okay, we'll have a way to adjudicate a dispute, and that happened in Delphi. There was an oracle, a woman. She was a mystic. Well, that's a debate, but it's a subject of discussion. And for 30 years, they said, let's stop killing each other. Now, what happened then? We had a war between Peloponnese and Attica, between Sparta and Athens. Here we are today, and we're engaged in a trade war with China. The United States and China. Which one is Sparta and which one is Athens? And what lessons do we learn or not learn from 2,400 years ago? I would advise people, if they haven't read it, to read Graham Allison's book about Thucydides' trap and his evidence of 500 years of recent history, which can point to one path or another depending on the leaders of the country. And there's another book by Paul Kennedy, The Decline and Fall of Great Powers.
Great book.
Great book. It's interesting because the book by the Yale professor Kennedy doesn't quote anybody from Harvard, and the book by the Harvard professor doesn't quote anybody from Yale, but maybe that's an example of a different type of competition. Now we think about it. Are we going to repeat history, the positive outcome or the negative outcome? The only thing we know for sure is that more will be revealed, and I hope in the next short period of time, a positive revelation comes from Buenos Aires. Let Xi and Donald tango together.
That's interesting. I don't know what that would look like. To follow on that point about the Thucydides trap, I'm familiar with the metaphor as it's used for U.S.-China relations. I haven't read Graham Allison's book. Of course, I'm familiar with the Peloponnesian War. And, of course, I think one obvious difference is that the Athenians were much more powerful force in Greece at the time relative to the Spartans. They had an advanced navy. They had a blockade set up, and they got, to your point about the Fed not having expected this trade war, they got ambitious, the Sicilian expedition. They also didn't expect the plague that hit the city, which took the life of their leader, Pericles. But I think it's probably a good point. I probably should have Graham Allison on.
May I add one thing to your history lesson?
Yes.
Athens had silver mines. They created a currency. It had an owl on it, so that's why it was called the owl. And they never diluted the currency no matter what. So they maintained the value. And the owl in the Mediterranean was the reserve currency accepted by the then world for 600 years because it was reliable and dependable. The second thing is they never used debt, except when they had to advance funds for war and defense. Otherwise, they ran on balanced budgets.
Interestingly enough, speaking of silver, it was, I forget the name of the admiral, the general who led the assembly to take the decision when a huge vein of silver was discovered in Athens between the two Persian wars. He pushed popular opinion to allocate the funds from the silver to build a fleet of triremes, which ended up being very effective in the Battle of Salamis against the Persians in the second invasion.
I love this conversation. It's Greek to me.
Thank you for coming on the program, Mr. Kotok.
It's a pleasure to be with you.
And that was my episode with David Kotok. I want to thank David for being on my program. Today's episode of Hidden Forces was recorded at Edge Studio in New York City. For more information about this week's episode, or if you want easy access to related programming, visit our website at hiddenforces.io and subscribe to our free email list. If you're a regular listener to the show, take a moment to review us on Apple Podcasts. Each review helps more people find the show and join our amazing community. Today's episode was produced by me and edited by Stylianos Nicolaou. For more episodes, you can check out our website at hiddenforces.io. Join the conversation at Facebook, Twitter, and Instagram at Hidden Forces Pod, or send me an email at dk@hiddenforces.io. As always, thanks for listening. We'll see you next week.